Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what we're seeing 1 month into the new year. After 2 years of downward trending inflation, the annual inflation rate has been increasing again since October. We expect inflation to keep trending higher into the second and third quarter of this year. Rising inflation hurts the Federal Reserve's case for cutting short-term interest rates. It's noteworthy that since the Fed began cutting short-term rates in September, the long-term Treasury yield has been moving higher unlike any previous rate-cutting cycle. Bond investors demanding higher yields for long-term U.S. Treasury bonds is their way of signaling to the Fed that they need to take inflation seriously again. If the Fed is unable to cut rates much further, it creates a more difficult environment for risky financial assets to perform well. Stocks are off to a positive start again this year. What's eye-opening is how much the price growth of the S&P 500 is running ahead of the actual growth at the companies themselves. This chart looks at multiple starting points in the past 2 years. Regardless of where you start, the growth in S&P 500 price is far ahead of the actual growth in free cash flow of the companies in the index. Price and free cash flow move together in the long run. Either the S&P 500 must stay flat for the next few years to let free cash flow catch up, or a market correction will pull the S&P 500 price back in line with fundamentals. 2024 looked much like 2023 in that a small number of mega-cap stocks drove the performance of the index. This chart looks back 40 years to assess the percentage of stocks in the S&P 500 that outperform the index. Only twice in the past 40 years have there been back-to-back years when 30% or fewer of the stocks in the index were outperformers. 1998 and 99 the first time, and then these past 2 years. The 98-99 period set up a multi-year run of outperformance for the average stock as the previous big winners peaked and returned to the pack. It would not surprise us if the next 2 years played out similarly, with the average stock outperforming an underwhelming index. We think it helps to realize just how large the 7 magnificent U.S. tech stocks have become compared to the entire country's stock indexes around the world. These are the weights of various countries and individual stocks in the global stock index. It's remarkable that 3 U.S. stocks have higher weights than all but 1 non-U.S. country in the world index. The other 4 Mag 7 stocks are also larger than some very important countries for the global economy. When you see comparisons like this, we think it's wise to look at the percentage of your stock portfolio that is allocated to tech sectors and consider shifting some of that exposure to other areas. We have 2 other data points that we think are worth showing as a reminder to keep your expectations reasonable for future stock returns from today's starting point. First is the bubble indicator that the team at Rosenberg Research created. It compiles a series of indicators like valuation and investor sentiment over the past 40 years to evaluate how much risk is in the stock market. We think this indicator matters today because the current level has only been hit twice previously, the dot-com bubble peak and the end of 2021. Both times preceded bear markets. The second chart looks at the forward price-to-earnings ratio for the S&P 500 and asks what the annual return was for the index over the next 10 years from that starting point. Taking all of these monthly points in time going back decades, when the S&P 500 is trading at nearly 23 times forward earnings like today, the next 10 years rarely delivered a return better than a few percent a year. This doesn't mean stock investing is doomed for the next decade. It means we need a correction and a wider assortment of reasonably priced stocks before we think it's accurate to say good returns can be generated in the stock market again. While we wait for the inevitable correction in the stock market overall, there is a positive to take away. The positive is that when the indices become overly concentrated in a small number of big winners, it is possible to perform okay while those indices are in longer-term drawdowns. The key is identifying high-quality, steadily growing businesses that trade at reasonable valuations. In the tech bubble washout of the early 2000s, the Dividend Aristocrats list of companies that have a long track record of increasing dividends was a good example of how to maintain purchasing power in a bad stock market. That's how we are structuring our long-term growth strategy. For example, the 4 stocks we added into the portfolio in January have been generating consistent growth in cash flow for 15 years or longer. They trade at 13 to 16 times earnings, and their average dividend yield is 2.5%. Buying stocks like these allows us to keep growing the cash flow of the portfolio while watching our downside risk. We hope that gives you a sense of what we're monitoring in the markets today. If you have any questions or would like to learn more about Oxbow, please contact us. We like to provide the information we think is most valuable to investors. If you'd like to see more of our insights, please subscribe to our YouTube channel.